Hey, microphone check, screen share check, please.
You're good. Check.
Okay. Hey, let's do a quick check-in. There's um, a few minutes late. I was putting together this lesson, and I think it'll be worth the wait. Get the Greg, what's going on?
All good. Happy to be here, Ken.
Okay. Uh, I have you listed as the dude. Forgive me if I can't associate faces and names.
Yeah, my name's Sean. I'm good. I'm ready to go.
Say John.
Sean, I'll put that on there. Before we met, it said, dude, I'm like, why isn't my name up there? And it turned out to be me, so I'll change that.
If you go into the three dots in the window, it'll let you rename that. That'll make it a little bit easier. Jonathan, how are you doing?
Doing well. Just going through the boot camp and starting to get an idea of kind of philosophy and how you think about things. So all good.
Okie doke. And Alex, how we doing?
Doing well. Happy to be here.
Cool. Lou, you all right?
Yeah, I'm good. I'm also happy to be here.
Oh, it's Sean. I was hearing John. It was like I'm sitting in the bottom of a rain barrel here. Jose, you doing all right?
Yes, sir. Happy to be here. Ready to learn.
Okay. And Dwight, how are you?
I'm doing real good. I spent a lot of time today just going through file after file, film after film, my whole day.
It's painful. It's suffering. I'm going through my own ICF coaching certification course, which is like 8 modules with 10 videos in each module, and it's a whole person holistic stuff. So I'm getting a lot of spiritual, sociological kumbaya, which is good for my soul and hard on my head. And I'm resisting the urge to play it at 2.0 on speed because I'm actually committing to trying to do it right. And it's actually pretty good. But I feel your pain. When I listen to my own voice on videos, it's just the most horrible thing that I can imagine, and I feel your suffering.
Yeah, I'm just amazed at the many hours you put in and still keep going.
Yeah, well, it's I got a lot of sins in a former life and in this life, if I'm being honest, to account for. So I got a lot of karma to work off while I can. So today's Q&A comes from Jonathan. He was asking me if I could discuss the execution R versus position sizing R. And what I should say for Sean, because I think this is your first session, the foundations course and the creativity course are lifetime access. Take as many times as you want, never expires, and the live check-ins really are geared towards finding out where you are, asking your best question about it, and then I'll go through it and try to answer it as best I can. And it almost always is beneficial to everybody. I would just say it's always beneficial to everybody, usually because the question will typically pull together an integrated answer. It's really, hey, you said this and you said that, and then you said the other thing, and I'm trying to fit them together. What's up with that? And it gives a chance really to kind of pull things together. They're rarely, hey, what is the settings on your ATR percentage? It's never that. It's always usually something that is getting to a core idea. And this one I think is one of the biggest emotional, psychological, practical concepts that came out of the era of the nightly podcasts and the hybrid trading, because it gets into something that's foundational in my mind about how we think about risk. And some of you guys have already heard me talk about the walking man and the 5 ways of knowing. That we have the knowledge of our head, the knowledge of our heart, the knowledge of our gut, the knowledge of our hands, and the knowledge of our feet. And that each one of them plays a really important role. So the knowledge of our head is our rational understanding. If I was going to draw a histogram, I would just say, hey, there's sort of this rational mind that is the normal way we engage in the world 2/3 of the time, and there's a pessimistic, fear-based, emotional element, and then there's the optimistic mind, which is when we have about 1/6 of the time, that when we have persuaded ourselves about an idea that it has merit, with our rational mind, then our optimistic mind takes over and says, well, I can see how that could be really powerful, and it kind of leverages up and it gets us into trading at the maximum mathematical level of risk, as if everything that we were persuaded was true is actually true down to the letter with no risk of being otherwise. And the mindset that I usually see at workshops in the old days when we would do them, 3 days over a weekend and just 20 hour. Imagine this entire course in 20 hours of just fire hose uninterrupted lecturing at you in a room full of 30 people, and you not having, confidence of asking questions unless it was a burning urgent, but normally just saying, well, I'll try to ask questions and sort it out later. That is a really painful way to learn. But you come away from that with some idea that I've got this rule set that I think is going to work, and there was some evidence for it, and so I'm going to trade it at the maximum reasonable level of risk. And then and only then there are some details in execution, because the market is never quite as easy as we make it. And I'm not sure how to do this or that, or I don't feel comfortable trading it the way he was trading it. And so you start making adjustments, and we rarely let the systems of other people unfold to gather enough data perfectly traded that we can evaluate them statistically. And so the problem is that our head is persuaded, and so we think about the optimistic mind. Our heart is associated with, our identity and a vision of the future, the thing that we're trading for based on values. And our gut is an emotional based, pessimistic mind, which says, I'm not persuaded by your rational arguments because I've seen the world eat rational arguments for lunch, or it's a belief that there's always a fat tail out there. There's some tiger in the bushes you haven't accounted for that's waiting to come get me. And I'm concerned about the risk side of this, and I'm not persuaded that in your head you've accounted for the fact that just outside the limits of our perception or your experience, there's all these tigers that are waiting to breach our perimeter and are going to come eat us. So while you've invested back testing and rationality into this system, I'm not persuaded yet. I don't have enough evidence to put my gut at ease. So the gut is doing its job by saying it's a dangerous world and that there are limits to what our rationality or our rules or back testing could do. Even if it just acknowledges that the world is an open-ended dynamic system that's changing maybe beyond the limits of what the back test covered. It says we haven't seen the worst adverse trade yet, so we should be careful of that. If you don't respect the fear-based, emotion-based knowledge of the gut, you'll tend to try to ignore it or control it or discount it or power through it, and that is never satisfying. It's just, and then if something does go wrong, it's, see, I told you so. And that tends to undermine all of the work that we're doing with our math and our professionalism that's associated with this central mathematically based mind that looks at evidence, and and is also looking at the optimistic mind. Hey, if everything worked really well or even better, what could we get? So the reasons, in my view, that systems fail in practice, and in practice I mean when you're actually trading systems on your own in the way that you understand them, in a way that makes sense to you on your platform and your time frame, and with your knowledge and expertise and your strengths and weaknesses. The knowledge of your hands is the how to do things. That your hands have to translate knowledge from your head and turn it into a tradable activity each time you trade with your conscious mind, with your hands trying to do things. You're trying to learn the skills. When you do that 1,000 times and you have a system that fits you and it's adapted to you, and you've had enough evidence that shows we can manage this risk, and it puts your gut at ease, the knowledge of the feet is the knowledge that is grounded in lots of repetitions and has become unconsciously competent. A lot of times we're picking up habits and rules of thumb that we're not even aware of, which I know to be true because when I work with experts, only about 30% of their knowledge is what we would call explicit knowledge. About 70% of expert knowledge, research has shown, is located below the level of consciousness, somewhere here in the unconscious or subconscious, and it takes actual skill and effort to go from the world of consciousness into the unconscious to bring that stuff out and convert it into expert rules, which can then be tested and taught. So when you're in a workshop with somebody who's briefing their system in 15 minutes or an hour or whatever, they're really showing you the expert knowledge that they are aware of. Now, hopefully they've done a good job, but I don't know if they have worked with a knowledge excavator, a knowledge engineer who has helped them go deep into their psychology and subconscious and pulled out all of the hidden assumptions. My shortcut for that are these Q&A sessions. Is that if I'm teaching a system, to 5 people, and they're coming from different backgrounds, and you're working with the rules, and then you come up with a question, that is like, it's better to do that, to surface it that way, than me trying to imagine what all your questions might be. I do my best to model what it is that I'm doing and to make it explicit so you can study that, but then you can also try it so that we can use these sessions of Q&A to bring those hidden things up to the surface. And in that way, when we're in these little Q&A circles with all these different perspectives, we have a chance of understanding the elephant in the middle of the room from all the different perspectives that we bring. So don't hesitate to ask questions. Send them to me in writing if we can so I can try to prepare material, but always ask them. It's never a bad question. It's always an incomplete or a bad explanation on my part. So I say that to say that it was the nightly podcasts and doing the distance learning and the Q&A sessions over extended periods of time that we really began to appreciate the importance of all 5 of these ways of knowing. And that learning to embrace the fearful emotion-based knowledge of the gut, this was not actually something we were trying to control. We realized you cannot control that because you feel the fear before you're even able to put words to it. You just know that there's anxiety. If you suppress that or don't investigate it, then what you're really doing is waiting for that to become a problem, and it will manifest in the middle of some painful moment. So one of the things that we want to do is honor and respect that part of our brain that is associated with the unknown beyond just beyond the limits of our rational tested knowledge, and respect the fact that its job is to help us become aware of potential problems before they get into our perimeter and eat our lunch. We can do some things to persuade our gut that we are listening to it by trading at a level of risk that is comforting to our fear-based inner gut, our emotional mind. So that's part of the insight that we got when it became clear that there was an important difference between execution risk and position sizing risk. The central idea is this: that on any pattern or trade frame, we have set up some kind of conditions for entry and exit and the yellow zone and some reasonable profit target that is favorable against the amount of execution risk. And we say, well, it met our criteria, whether it's 2-to-1 or 3-to-1 or 10-to-1, whatever. There is a reasonable argument to be made that the amount of risk that I'm taking is manageable, that I'm not going to take more than 1 hour execution risk, that when I put that pattern together, there is a hypothesis to this trade which says, if I get long here, then there's a good chance for that thing to get up to 2R based on the amount of execution risk that I have, that this is not an unreasonable profit target. On a swing trade, I always use the 10-day high because that is a recent enough price in the swing trade time frame that it wouldn't be crazy that the sell-off was an overreaction and then is going to respond when enough people realize, that's a buy on dip opportunity, and I'm going to come in with new money and buying pressure and take advantage of that thing on sale and move it back to what turns out to be long-term fair value. I just use the 10-day high as a reasonable proxy for swing trades to say, typically this thing has moved away from the 10-day high. Like there was a strong move that took it up to that 10-day high. And then this was some kind of retracement that brought it down to a moment in which I can now see that if that was an overreaction, and if buyers come in, getting it back to the 10-day high is not crazy, and I'm getting a 2-to-1 reward to risk ratio. So that establishes my trade frame. That's the hypothesis behind that trade setup. It simply says that for this amount of execution risk, that if I get long here, that's enough evidence from the low that if this thing keeps going, that it could get to the profit target in a reasonable amount of time, and that the price, after I entered, if I saw price fail through this level, then in fact, whatever it was that was causing this sell-off, which you will hear me in a lot of systems just call the harsh winter, the noticeable abnormally large selling, well, there's a reason, apparently, there is a reason why this thing is selling off. I don't know what that is. That reason is in the minds of all the sellers who are taking the position that the short side is a good trade, and it's in the mind of all the buyers who are not buying it. If it sells off this much, they're not buying it here and here and here. They're letting that thing fail because of whatever reason it was. These guys are persuaded it's not time to buy yet. And these guys are all persuaded selling is the order of the day. When you put those two pieces of psychology together, you get abnormal sell-offs. It's the size of the abnormal sell-off that typically alerts us to the fact that something unusual is going on, and that the fear that is normally associated with selling may cause this to be, there may be an emotional component to this abnormal selling. Like maybe the rational selling on bad news was to here, but the fear that was triggered by guys that were long this thing with leverage, maybe this is an emotional amount of selling. I don't know. All I know is that if this thing has stopped failing and instead has started to reverse, that perhaps a move of this magnitude is enough evidence that the tide has shifted, that all of these guys that made money on the short side are satisfied, and maybe some of those guys have moved over into the buying category because they're short-term traders and they're trading this thing in both directions with a neutral bias. And maybe the amount of the sell-off has attracted new buyers and their money who said, here's a chance to buy value on sale. So now the short-term psychology has changed, and now there's enough buying pressure that says maybe that was the beginning of a recovery move. So if I say that was the amount of evidence that takes me to be interested in this as a potential reversal, I want to see two of those back to some reasonable profit target. So Lou asked, do I use the 10-day high? Yes. For an auto framer to identify potential targets? Absolutely. What I learned was, over a lot of swing trading, was that I had about 6 different patterns of mechanical identification of abnormal opportunity, in which the rewards typically were bigger than the risk that I could comfortably manage. Right? And so, like a 5-day down, there were 5 lower closes, and that was quite often an overreaction that had some emotion in it. And then I could frame a little trade based on the last day's range and call that the mechanical entry. And if I got long 5 cents above yesterday's high with a stop 5 cents below yesterday's low of the setup day, that I could call that one execution R, or the mechanical risk, because I would just mechanically enter on a breakout above the setup day's high plus 5 cents. And if I set the 10-day high as the target, usually a 5-day sell-off that had some emotional selling, I could almost always see 2-to-1 to the 10-day high. Well, what I would do is I would check the 5DD, the 551W, the triple screen, the channeling, the overreaction. Let's see, there's another one in there. The washout pattern. All of these different separate, unique, individual signals for potential trades. Quite often, on days when the market, or a week where the market has sold off a lot of these things are firing for their own independent reasons. So now maybe I had 20 valid signals from 6 different swing trade patterns. Well, which ones do I want to prioritize? How can I compare them? I know. I'll just compare them on the basis of reward to risk using a standard measure of risk, which was the setup day's mechanical risk. And then how many of those, 1, 2, 3, just back to a standard 10-day high. And on that basis, I could now start qualifying these trades on the basis of a standard justifiable reward to risk. You can't backtest that to find, well, what's the best way to judge a standard reward to risk against 6 different patterns that have uniquely separate. You can't backtest that unless you got artificial intelligence. So what I could just say was, let me use a reasonable price target of the 10-day high as a reasonable price target, and then a standard risk box of yesterday's risk, and then if it took out yesterday's high, so if this was the setup day for any of these patterns, I could stock that, and I could say the first price that would tell me that the retracement was happening was if it opened in here and then broke through yesterday's high plus a buffer of 5 cents. And now I started seeing price take out yesterday's high. I now had evidence that buyers were coming in and buying it at a price that they were not willing to buy the day before. So this is actual evidence that buyers are starting to come in and take it higher because they're willing to pay a premium compared to what was on offer yesterday. That's all it is. It's the first price that says I have new information that was not available yesterday. Yesterday's range is simply the yellow zone. I have no new information about the relationship between buyers and sellers until yesterday's high is taken out. That's the argument for the auto framer. I learned after doing that for about 5 years that the auto framer itself, regardless of the pattern, could give me trade signals simply on the basis of trade location. And in fact, if yesterday closed at a tiny little doji, no matter what, and that was some distance away from a 10-day high, that little doji gave me the ability to frame some outrageously good reward to risk ratios. And now, all of a sudden, the auto framer has become my default frame of reference for judging all of my standard, normal, usual trades. It's the first thing that I look at. How do you get a really good auto framer? There are 2 ways. You need a very small risk box in yesterday's range, so that's range compression, and you want a long distance from the 10-day high. When you put both of those 2 things together, you get a reward to risk ratio that is large. It gets bigger. So that whole idea became the MPRC, a strategy which simply says what I look for from scratch is maximum pain, sell off from the 10-day high, and range compression. Well, that's what it does that's the argument for swing trade and how to have many different signal generators come into a standard way to evaluate them on the basis of standard risk reward. That is what I would call standard work. I use that standard work in order to evaluate all of these different independent ideas because I'm actually going to enter on the basis of took out yesterday's high with yesterday's low as a reasonable execution risk. Like by the same token, if it goes below yesterday's low, I have new information that this thing is failing. And if the previous move was a max pain and it ended in a tiny little doji, which is directionally neutral, imagine the change in psychology that happens when you go from max pain, runaway fear and loathing, to all of a sudden a tiny little range in which bulls and bears are neutral. They are equally in power. The difference in psychology from runaway fear to tight range compression with no directional bias is enormous. What that means is that there's a 50-50 chance that the bulls might win and take it back. Or this is the pause that refreshes and no bulls show up, and now all of a sudden the bears come in, and now the size of the second move is the size of the first move. So a max pain range compression that ends in a doji is the very operational definition of a critical state in which you have the smallest amount of indecision and in which you have an opportunity for large moves in either direction in a short period of time, because all of the emotion that brought it down to that doji is ready to erupt in another. It's already in play. So that's the argument for max pain, range compression. That's why the auto framer is so important. It is trade location. And if you get an auto framer, the things that are large in the auto framer are things that have a combination of largest sell-off percentage and tightest range compression. That's why I sort by that ratio. Well, guess what makes an amazing intraday trade target? Something that on a swing trade has this amazing reward to risk ratio in either direction. Now, when I go into the day and I break it into 30-minute segments, maybe that thing gaps down and starts rocketing back up because they collected all the lows, all the easy money, and now they're ready to take. They bought all their inventory down here, and now they're going to run it up during the day. And there's some price up here where if it breaks through that, I'm justified in taking the swing trade, but maybe I can put a small risk box intraday. I can respect yesterday's low, and I can say, if it breaks below yesterday's low, I'm going to be short. But meanwhile, I have a manageable intraday risk box, which has 5 risk boxes just to get to yesterday's high. That would be amazing. I love that. Now, if I can get an entry in here and get my risk out of it, I can just collect some cash. And then if it stalls near yesterday's high, it's supposed to stall there. That's where it stalled yesterday. I'm out of it. I made some money. I'm good to go. I let the swing trade reward to risk ratios help me identify amazing candidates for tomorrow's intraday trade. So that's one of 3 categories of excellent targets. New swings that are at least 2 to 1, as I said last session, and any continuation swings where that swing after the 5DD, the thing is already working and it's had one good up day. Guess what that looks like? That looks like evidence that this was an overreaction and it's trying to get back to the second day is quite often even better than the first day, because now the guys that were scared are coming in and now their fear of missing out. That may be the best day of all, is the early move on the second day. Second day continuation. So continuation of any positive trade, whether it was a swing trade or whether it was a day trade, any continuation that I made money on, I'm automatically going to frame that and be ready to follow through tomorrow. And the third one is the old reliables. And that is, if I don't have any new swing trades or no continuations, I have a set of reliably large movers that are ready to go in either direction and could become a range stat kind of a move, and they're very liquid, and I have them scattered from all over different parts of the world market model, so that no matter what's working, is it energy? Is it tech? Is it finance? Is it industrials? Is it materials? Is it Brazil? Is it Mexico? All of those things can out of nowhere just go, especially if yesterday they were in a doji. So I'm always ready to trade the old reliables. Where's my list of old reliables? It's the ones you see on the daily report. It's the ones you see me trading on the 30-minute time frames with the hybrid swing. That's all I do every day, most of the time. is I trade those. And if one of those is on a swing trade, that's gravy. If one of those was good yesterday, I'm really ready to trade it tomorrow as a continuation for 2 or 3 days until the energy runs out. You know what else I'm ready to trade intraday? Is anything that moves like that intraday. This is the S&P, and from 1245, it dropped down to here. It made a range stat move in 90 minutes. You know what a range stat move is? Yes, you do, because you're in this course. A range stat move is the average range plus one standard deviation or a frog box. 85% of the time, the S&P will not move more than that intraday. From the high to the low, 85% of the time, it will move less than a range stat. Here, it moved a range stat from here to here in 90 minutes. That is the definition of an abnormal move, an irrationally exuberant large move. That is a harsh winter. Guess where it triggered? It triggered when it crossed the VWAP and then made an enormous move down by 215. You know what that probably was? It was probably intraday traders trading the ES contract with a ton of leverage. You know what they've got to do before the end of the day? They got to get out of this short position with leverage. You know where their target for settling up at the end of the day for capital is? It's the VWAP. Look how much farther away from look how far from the VWAP they went. So when they get out of those positions and they have to cover, they suddenly become buyers. That's them buying to cover all of the shorts. And that triggers momentum. And guess where that thing gets to before the end of the day? It gets back to the VWAP. That is the VWAP magnet trade. By the end of the day, they have to unleverage all of those abnormal directional moves. It happens all the time in the big fat indexes. That is industrial strength money. You know what I am? A tiny little mouse just taking advantage of statistical anomalies and looking at pSAR flips and getting a little momentum, getting my risk out and riding it until it's time to get out. When is it time to get out? When the pSAR flips? When is it time to get in? Probably when the pSAR flips or a key support level is broken or it becomes the start of a winter. And when the consolidation fails, I can add a position because it's supposed to recover and it didn't, it's failing. I can continue to ride it. And the pSAR never moved. Do you think I'm going to be ready to trade the S&P tomorrow? Yes. Why? Because I'm always ready to trade the S&P, because when industrial strength money comes in and starts hitting the buy and the sell, that thing moves in these short bursts. I'm never surprised when it's like, hey, but it didn't do anything in the first 90 minutes. Yeah, that's just a Z3 pinch, and that move catches everybody by surprise. When is it time to get in? When it breaks the Z3 line, or turns to the harsh winter, or crosses the VWAP. Lather, rinse, and repeat. I don't believe in that trade, but I take it. When do I know it's starting to slow down? Well, when the sell-off slows down enough so that the harsh winter has now become the spring. It started telling you right in here that the sell-off was slowing down. And then when the RL10 bottoms out, that's where the pSAR is going to flip to. And you can see where the pSAR after an extreme move has come down to the northern skin of the dragon. That is a buy signal all frickin' day. In the same way that that is a sell signal all frickin' day. Hey, this is on 3-minute charts. This could have been a 30-minute chart, and you interpret it the same way. This could have been a daily chart. This could have been a 3-day chart. This could have been a 9-day chart. It's just, how long does it stay in the individual bars? You interpret it exactly the same way, and that means we are trading fractally with standard work on standard patterns. Now let me talk about execution risk and position sizing risk. I just said that every pattern that I'm going to teach you and that you will learn has a hypothesis. There is some trade setup which says that because of the previous information, an opportunity has arisen, which if it leaves that box, I can get long because there's at least two of those boxes up to a reasonable profit target. Swing trade, 10-day high. Intraday, it could be the VWAP. It could be the RL 270. It could be yesterday's high of the day. It could also be a range stat from the low of the day stacked higher. All of those are reasonable price targets intraday. Previous support and resistance, reasonable. It was just there. It could get back to there. It was there already today. So, by the same token, there is a price which tells me that this hypothesis is not working, that in fact it's the previous hypothesis. The best trade frames are ones in which we have a compound critical state. What do I mean by a critical state? I mean that there is a larger than normal percentage of a larger than normal move in either direction in a short period of time. A compound critical state is one in which, in multiple time frames or for multiple reasons, you have evidence that this huge move could happen. Like if the price that gets me long would trigger a 3-minute intraday trader and a daily swing trader or a weekly breakout, that's 3 different populations of traders that are all ready to commit money for their own independent reasons. And when all 3 of those guys hit, guess who gets surprised by the size of that move? Every single one of them. Because the 3-minute guy's only looking at the 3-minute charts, and he's used for this thing moving a certain distance as an intraday trader. Unless he's looking at the daily chart and the weekly chart, he doesn't know that there's a bunch of money that's ready to trigger on that. And instead of stopping here, that thing just goes. Guess who else is not aware? The day traders, if they're only looking at their trades, they don't see the day trade money and the weekly money. So when you get committed to a certain time frame, it is possible that you could have blinders on, and then all of a sudden price starts happening for reasons that are not apparent on your screen. And all it means is that other traders from other time frames have reasons to get in or out of the trade that you're not aware of. Now, what you will probably do is try to go on your chart and add indicators and explanations, say, why did that move so I can explain it, when all it really was a compound critical state happened and you got surprised with a huge move. All I want to do is try to identify a compound critical state, and then if it starts moving in one direction, I'm going to try to get long with a stop here, and as soon as I can, get my risk out. So now it's just, I don't have any of my core capital at risk. All I have to do is follow price and just increment my stop and just see how far it's going to go. Maybe it'll get to my 2R win. Maybe it'll go to 6R. Maybe it fails right away. I don't care. I've got my stop in place and I made a little bit of money, and that's all I was trying to do, was protect my capital and then just turn this into a science project to see how far it would go. So I have no expectation. I just have anticipation or opportunities, and my only job is to manage my risk professionally. And then I will keep track of the score later to see how good that initial compound critical state is. If I have done my job, my histogram is going to look like this. No losses greater than -1 execution risk. It'll give me a positive expectancy on the average win. that most of my trades, that 85% of my trades are going to be from between -1 and +2 in a normal looking histogram. And I'm going to have about 1/6 of my trades out here with fat right tails, which is what happens when the traders from the higher time frames come in and start hitting it just like me. So I get my little move in, and instead of failing right here where I get out, they come in and they start continuing to buy, and it goes all the way to the VWAP, and I get maybe a 3R win, which is well above my average win. All this means that there were guys from the higher time frames who were still buying that. And all I had to do was get my risk from here above my entry and not let it ever go negative. And then the numbers take care of themselves. So that's industrial trading with compound critical states. Now, I said that all of these patterns, now some of them are systems that have very precise entries, exits, and targets. Some of them are strategies which are relaxed trade frames that give me a little bit of, like if I have a trade strategy that wants to use the pSAR as the execution risk, look what happened in SPY today. At the very top of this sideways quiet channel, the risk box between the pSARs was only that big. It was the size of this purple box. After this abnormally large move, which was a range stat in one direction and never looked back, it never even came close to violating the dragon and never even came close to the pSAR. That's an extraordinary move. The size of the pSAR box, based on math, was that big. Look at the difference between those two execution risks. So clearly, the local context of the trade makes the distance between the pSAR dots variable. So in this case, I might be justified in saying, look, I'm going to get short if it breaks the pSAR, and if it breaks the pSAR to the upside, I have enough evidence that maybe I should be long. So that looks like about 20 cents. Down here, I have to wait for that's $1. This box is almost 5 times larger than this. That's 30 cents. So this box is 3 times larger. Now, the execution risk is justified by the logic which says that the pSAR statistically is a very good definition of the difference in long side versus short side bias. That is how much statistically there is yellow noise or uncertainty between buyers and sellers. This was such an abnormal move that it loosened up their brain and it made the yellow zone much wider. That's still one execution risk. If you look at traditional teaching on how big your position size could be or should be, novice teachers or traders think that's the same thing. They are using their optimistic mind to try to find the maximum justified position size. I'm not trying to do that. I'm trying to trade carefully and professionally. So what I say is, because there's a variable, let me have a standard risk per target, which incorporates a lot of different variables. What's the size of the range stat? How volatile is it? Where is it in its 10-day range? Did it have a swing trade pattern before? Did it just complete an extraordinary move? All of those things that, if you started making a list of all the things that you should think about, we could be here tomorrow and have 100 things on that list. Do you want to go through all 100 of those things when you see an opportunity to get short to try to decide how big? No, you don't. What you want is standard risk that allows you to have a reasonable sized box that makes sure that you don't get too large. So what I do is I say, let me separate the execution risk from the position sizing risk. And what I use is a standard pRisk, which says I will never take greater than 1R position size loss. So what I would like to do is I would like to be able to take that trade very quickly without worrying, and I can say, that's going to be my execution risk. Let me set that equal to a 0.2 or a 0.3 position sizing risk. Or I could be even simpler and just say, let me pick a frog box, which is, in this case of the S&P, statistically speaking, almost $2. And this is a 20 or 30 cent risk. If I position sized against a frog box, and then this thing I got short right here, and instead of having this move, it reversed against me. It's a separate pattern which says, should I stop and reverse there? Because of this move, the answer happened to be yes. I knew that because of the trade frame that I built based on the previous price action. I knew that if I got short here and it didn't break through the VWAP but just started to go, that I want to be long here because of reasons. So I know that before I'm already here. So my amount of indecision is only the execution risk. I know that there's enough room to the upside that it's worth taking that trade. Did I think it could make a range stat? I knew it was a statistical possibility because this was actually the high of the day. Mathematically, it could move there, and I'm not allowed to be surprised. If it moved any farther than that, I'm entitled to be surprised because that is the absolute limit of maximum reasonable intraday moves. It just so happens that when the S&P goes past a range stat, how much further can it go? It has actually been 2 range stats. So Jonathan asks, good question, where does the frog come from? 20 years ago, when I started day trading statistically, I said, let me compute a statistical measure of the difference between signal and noise. The measure that I settled on was to go back 30 days of range and find how big was the high to the low, and then compute all 30 of those, and then find the standard deviation, and that would, the standard deviation of those ranges, and that would tell me how variable those ranges are. It turns out that if you have an instrument that almost always trades that much, and there's only a few days where it traded less than that, and a couple days where it traded more of that, but it's really a tight spread, your standard deviation is going to be small. And what that tells you is when you start calculating how many standard deviations fit inside the standard average range, that gives you a frog index. And why do I call it a frog? Because when I was a child, I used to hang out at a pond, and in that pond there was a lily pad, and on that lily pad there was a frog. And no matter how carefully I stalked and crept up to that guy, when I got within a certain range, that frog made a huge jump, and I didn't know if he was going to go there or there or there or there, but he always jumped far enough that whatever was stalking him couldn't catch him. And he could land and reset faster than I could go there and get him. So he was always one jump ahead of me. And that thing was absolutely stable and quiet. His little frog eyes would look at me until I breached that line, and boom, he was gone instantly. So what I did was I was going to teach a workshop on day trading that had some complex patterns. And my wife and my neighbor's wife wanted to day trade. So I gave them a set of rules which said, from the start of the day, if this thing moves a frog box in either direction, I want you to get long, and I want you to trail with a frog box. And when that thing rolls over and it hits your trailing stop, I want you to get out. And if it goes short, I want you to get short, and I want you to trail it with a frog box until that thing moves one frog box. And for reasons that are detailed in the advanced day trading course, there are times when you want to wait 60 minutes, times when you want to wait 30 minutes, times when you want to wait 0 minutes. And that is the slow frog, and that is the quick frog, and that is the leapfrog. And it turns out that you need 0 indicators on your screen, and you don't care at all what the previous price action was. You start with the open, and you put 2 boxes on there, and you just trade that. When you wait 60 minutes and then trade those rules, which are, I think, in the foundations course, but I don't teach it. And if you are a super trader like Matt B, he traded that over 4 months with 800 day trades, and his win rate was 54%, and his average win was 0.7, and his average loss was minus 0.3. Over 800 trades in every possible market condition that you could imagine on a whole range of symbols that were very, very liquid. How often do you want to trade that system? Forever. That's what you want to do. That's the ballpark. That's trading with no information from the day before and no indicators on your screen except a box. Call that visual box trading. You'll see examples of that in the foundations course. The name frog comes from the fact that that's the animal that this most closely resembles. Now, if you have trader skill and you have some indicators and you have some information from the day before, you know what you can do? You can just wait to see if that thing, if it had a 5DD and this was yesterday's range, you already know that that price is really important, and you know that that price is really important. Because if it goes below there, you have a 5DD failure trade, and that's a massively good trade. And you know that if it gets above this price level, you can just mechanically enter it because of the power of the 5DD. Because it's going to give you 5 to 8% over the next 3 to 5 days in bull markets historically. But what if that thing opened right here and you know that the average sell-off from the open to the low of the day is right there, and we call that the fail stat. And in the S&P, the frog standard deviation is there, and the fail stat is $2.52. If it opens there and it sold off $2.50 and it got to this level right here and it did not violate yesterday's low and it put in a low of the day right here, and your R10 was 60 cents, you actually have a 4-to-1 trade from the open to the low of the day, and it's very close to the fail stat. And then if that thing starts moving this way, you have reasons to believe that that could actually be the low of the day because of the logic of the fail stat. And you know that if that is the low of the day, what is the high of the day? The maximum reasonable intraday move is from the low of the day, which you've identified so far is right there, and you add a range stat to it, that thing can move $6.14 to here. And if you are using an R10 of 60 cents, and you saw it move that far on an SSC pattern, you could have a 9-to-1 move if it just does a range stat move, which looks just like that. Hey, what if a R10 is too tight for you to manage? You could actually use a frog box. Let that thing move a frog box off the low, and then you could enter that, and that's only a dollar. What was it? $1.77. So if it moved if it moves $1.77 off the low, and it can move $6 to a range stat, there's still $4.23 of potential move, which is a 2.5-to-1 if you used a full frog box as your risk. You could, guess what you could do? You could let it move a frog box off, use that for position sizing, but use an R10 for your execution and still have a 6-to-1 move on a range stat. So my point is, in the same way that we have multiple signal generators for swing trades, we have multiple systems for day trading. And it turns out that all of these swing trade signals make really good day trading, so you should be investigating what about the pure simplicity of visual box trading with the frog rules? Or what about the RLCO framework that uses something like the fail stat, the intraday range? What about a harsh winter that gives you an SSC and Kata 2s and collapsing dragons? That's a compound critical state, which I am teaching explicitly inside of this course. So what you just got there was an executive summary of everything important in the swing trade workshop and the day trade workshop and the hybrid trade workshop, plus the foundations course workshop. Now, what I want to tell you is that the execution R, if you just had that at 0.2 to 0.3 of your position sizing risk, then you could take the long here, and you could decide to set your risk right here, your execution risk. And if you said that's $1, and if you said, I'm just going to arbitrarily set that equal to a 0.2 loss, then that means that my full 1R loss for position sizing would be a $5 risk. And if I was going to commit to standard risk per trade of no matter what, $100 risk, and I decided that my risk for this trade for position sizing was going to be $5, then I could buy 20 shares because I'm using position sizing risk at a fraction of a chip, knowing that this thing could move $6. If I took $1 risk of execution and it could move $6, there is $6 of potential reward against the execution risk. So I'm using execution risk to justify the hypothesis of the trade, but I'm using execution risk to guard against this adverse psychology of worrying about losing my capital, which is driven not by my head, but by my gut, which is worried about the tigers I haven't seen yet, especially when I'm trading somebody else's system with real money for the first time. So how do you make that system your own? You exaggerate the low risk that you're taking by setting the damn thing equal to a 0.2 loss of position sizing risk, and position size against that until you have 500 trades live with skin in the game, until you persuade your gut that your mind, your head, is properly trading this with the knowledge of your hands and feet, that you know what you're doing with the trade frame. You've seen enough evidence that you know the right size amount of risk to take. Then your gut will say, thank you for generating 500 live trades with skin in the game so that you respect my uncertainty. I'm going to calm the fuck down. So how do you do that in practice? You start with one share live. After you have paper traded it forward, that you feel like you have all the trade frames ready, you put skin in the game with one share live, and you risk $1 or something like that, whatever. You trade one share live. And then when you have skin in the game and your one share live trading looks like your paper trading, only then can you say that your paper trading was worthwhile. And then what you do is you start risking $10. And when you have evidence that you can manage $10, don't worry about the cost of commissions, because when you're trading one share or $1 or $10, the amount of commission and slippage that you pay is a larger percentage of your gain than will be the case when you're up at production level. So don't let that chase you out of a good system. Just accept the fact that when you're in testing mode, forward testing mode, that the admin cost doesn't matter, because it's only $1 or $2 or $10. It's $1 or $2 a trade. Don't let that be part of your calculation. When you get up to production level and you're trading 400 or 500 or $1,000 a trade, then incorporate the cost of doing business as part of the load that your system has to carry. So what you do is you start trading forward with $1, then $10, then $25, then $50, until you get to some level of production in which you now have all the evidence in the world that forward trading with skin in the game continues to work. When I see people misusing backtesting, what they do typically is they invest a lot of time and money into the backtest in a perfect world, and then when they trade it forward live, they trade at maximum dollars with their optimistic mind, and then the first time it starts taking some losing trades, they start changing the system, and now they have no evidence that the system that they changed to is any good because they backtested the perfect rules. So don't do that. Backtest as much as you need until you can paper trade forward. And then do enough of that until you can start trading one share live with skin in the game. And then start growing the dollars at risk. And then the amount of money that you put on the trade is earned by the real world results of that system. That's how you do it. If I put $5,000 into a futures short-term trading system, I would trade that in the following. I would trade those patterns at low levels of risk until that account was worth $10,000, and then I would take five, and I would never change the position size until I got to 10,000. And then I would take my 5,000 and set it aside, and then I would take that $5,000 account and I would make it 10,000 again, and then I would take 5,000 out and put that over here, and I would trade 5,000 until I made it 10,000, and I would take that 5,000 out until I had, for the initial 5,000 that I put at risk, I got 10,000 out of it, and that's my 2R win, and then I would grow that to 10,000, and then I would start trading that as a percentage of the account, because I had just created evidence that the way I am trading with a standard frame and standard risk and standard position sizing was valid. That's how I would do it. And if I was an old man and knew young people that were willing to become traders, I might fund their account halfway and have them put skin in the game, and then see which of them could actually do that, and then that would be my trader. And I could give them rules and I could manage their performance. I leave that to you to figure out how to either automate that or build a trading team, but that's how you do it long term with a 20 or a 200-year time horizon. It turns out that one of my nephews is an actuary, and he's 28 years old, and he has 2 kids and a wife who's a PhD chemical engineer. And that kid is solid with numbers, and he is risk averse. He's perfect for what I want. Now, I want to just check in with you and make sure you understand what I mean by the difference between execution risk and position sizing risk and how to use that. When you put the trade frame together, you have your risk box and your reward box, and you put the execution risk, you put your execution risk or your XR based on the pattern that you are trading. There's a logic or a hypothesis to that trade. If it's the PSAR flip, it's the PSAR flip. If it was the mechanical entry of yesterday's daily range and you're doing swing trading one day at a time, and you were going to get long 5 cents above, and you were going to accept 5 cents below as that, then that is your execution risk. And that's quite different than an R10, which is 1/10 of the range set. It's different than the frog box. Yeah, each one of these is a different logic. The 1 ATR or the range set. Here in the S&P, 1 ATR is smaller than the range stat, just because of statistics. So whatever the pattern is that you are trading, whatever the trade frame is, you've got to have a minimum of 2-to-1. I would prefer more, but I'll take 2-to-1. Maybe you want 3-to-1. That's fine. You decide, it's your risk. But you must have at least 2-to-1 execution risk to your reasonable target. And then your position sizing risk, I want you to just do what I tell you and let that equal 0.2 so that you don't feel tempted to execute inside of this little range right here. This is what happens all the time. I talked about this last week. Go listen to that again. But if you said that was your hypothesis and you set that equal to 1R and then you position sized with that as your position sizing risk, and then all of a sudden you got long and it started to fail, and you've heard me say time after time, don't take more than a 1R loss. You could be tempted to execute inside the noise, and there's no justification for doing that because this is a noise box. So get around that by tricking the monkey inside of you and say, not even tricking him, you're being objective. You say, look, I think that is the objective measurable risk, but I respect your concern. We are not going to blow up this account. We are just going to arbitrarily set that equal to 0.2, and we're going to position size against a full 1.0 risk box. If you follow that instruction, you cannot possibly take a 1R loss unless you do what I am doing with that overnight swing trade risk. And because of the gap, which is the great killer of swing trading versus day trading, you've seen me take 3 to 5R losses compared to the intraday risk box. But guess what? When I take those overnight risks, I have put into the account plenty of markets money so that I can handle a 5R loss as if it was just 1R. Because I have markets money in hand and I've made a deliberate decision to do that. Or you could just say, don't take overnight risks unless you have a winning swing trade in hand. That's another lesson for another day. I want to make sure that you understand that the execution risk I want you to use when you are evaluating the potential reward so that you can get 2-to-1. Because otherwise, if I had a $5 risk box down here, I'd have to see $12, and that's a double range stat, and I could never get a trade. So all I have to do is qualify this on the basis of the execution risk, but I'm going to use the position sizing risk in order to honor and respect the importance of my gut, which is where my fear of uncertainty lives. Don't try to control that or manage it or suppress it or eliminate it. That's what has kept us alive as a species in a world that hates us. Wait till you get 500 trades of live money and that your hands can reliably construct these trade frames. After 500 trades going forward with successful trade framing, you'll know what to do to adjust your trade. And then, by the way, if you had 500 trades and it was positive expectancy, I would also tell you, don't change the trade frame. Just increase dollars per trade and don't change the architecture of the trade frame ever. If you had 500 pieces of evidence that you could trade with positive expectancy just like that, why in the world would you change that? Just increase the amount of risk per trade by increasing the dollars. How do you do that? Grow the trade from results of forward trading and trade as a percentage of what it has earned. And then portfolio heat is a separate topic for another day, which says, of all the systems that I have with open trades, what if they all failed right now and hit their stop? How much do I lose? That is my portfolio heat. And what is that percentage? If it's more than 20%, I'm going to wonder why. That would scare the living crap out of me. But I have an exaggerated sense of fear, and I have a 200-year time horizon, and I know that if I trade this way, I am less likely to get eaten by tigers. Check or hold. It's at 8:30, and I'm getting ready to do the daily report here, but I want to make sure that there's no burning urgencies.
But Ken, the position sizing, it's all trading decisions are made off of the execution risk, but the position sizing, it's kind of a way to tricking yourself into thinking
That's right.
that you're trading a larger size than you really are.
Yeah, what I'm trading 5 times smaller than my optimistic brain wants to do it,
Yeah.
and that satisfies my gut. My gut says, "Hey, thank you for trading at only 1/5 of the size that you desperately want to trade at," because the mind of the gut doesn't listen to your rational argument. It hears every rational argument that you make as a hidden, you're hiding the emotion of greed, because all it knows is emotions of fear. So it assumes that your decision is based on the opposite emotion of fear, which is greed. It doesn't understand rationality as a real thing. It thinks that's just you lying about it. So it says, you're just being greedy, but thank you for cutting your appetite back by 1/5. And then later, when we've accumulated 500 trades of evidence, we can say, oh yeah, okay, I got it. I guess you really, and by that time, we've moved on, and the architect and the accountant and the risk manager has taken care of all this, and you've automated that system that you don't need that artificial stuff anymore. But as long as we're monkeys, this is how you use psychology and math to overcome our prehistoric emotional fear center, which I embrace because it is who I really am in my core. Because I've faced existential fear many times in my life, and my sense of fear has kept me alive on the battlefield more times than I can tell you. And I never question that. Never. So, when I talk about sniper exits and getting out of perfectly good positions all the time, I hope that I continue to get out too early for the rest of my career. I hope that I leave money on the table and that in retrospect it looks silly. I hope that continues to be the case. I'm not trying to engineer the optimum maximum potential size. If you read Fortune's formula and listen to Ed Thorpe talk about the Kelly criterion, which is the mathematical maximum position size justifiable by the previous performance of a system, even he says, never trade the Kelly criterion because you haven't seen the worst trade that's waiting to get you. He says if you're very aggressive, maybe a half Kelly or a third Kelly or a fifth of a Kelly. And when I read that, I said, oh, I guess I'm not stupid after all. 1/5 of the mathematical optimum for a rational, optimistic mind, because we're talking about systems that are prone to human intervention before we even know it, and manipulation and all the unfair advantages that institutional money has. And when you add algorithmic trading and leverage and flash crashes, dude, protect the risk, respect your fear. It is your gift. And that is coming from, you know, a career of combat experience in a different setting, but it's the same setting. I treat it with the same level of respect as I ever, everything I do anymore. The same. If it's something that I don't bring that level of respect to it, I shouldn't even be doing that at all. I only got time to do things that matter. So that
Yeah,
is, go ahead.
Yeah, quick question. So it sounds like you don't use percentage of equity per trade. Would it, like 1% of equity be risk per trade? Are
Oh,
you
Jesus, no.
suggesting that it's 0.2% or?
I'm less than that. I know how
Okay.
much money I need, and I know how many trades I can put on at a given time. And the smaller the unit of risk, the more simultaneous trades I can take. The more simultaneous trades that I can take in positive expectancy systems, the more likely I am to get the expectancy of the system. That's math.
Smooth the
That's
curve
math.
out, yeah.
That's right. So I trade on the basis of minimum required amount to achieve my financial objectives. I'm not trying to optimize capital efficiency. Because if you go too far in the other direction, you get long-term capital management. So I say that is the percent capital risk per trade is a personal decision that you should make that is informed by your personal circumstances, how that system and that trade fit in as large of your, like I could do 1% on a speculative account, but on my long-term bet the farm account, I'm nowhere near that on an individual trade. Because those, anyway, so if the herd says 1% is the standard, I don't ever want to be the herd when it comes to making risk judgments. I automatically don't want that. That's just the way my contrarian mind is. If you took a look at Las Vegas and the house, and they put limits on tables, and you look at the number of simultaneous games that they have playing at any one time, what percentage of the casino's portfolio does any individual gambler's trade represent as a percentage of their portfolio? And when you got 100,000, I don't know what the number is, you got 100,000 people gambling every second, the probability of some of those guys being adverse fat tail trades against the house is large. So they want the expectancy. So they drive the number of risk per trade as a percentage of portfolio way, way low. I want to be more like the house and not like the gambler. So I would like you to reflect upon that for a week. And maybe we can talk about portfolio heat next week if that's an important topic for us to talk about. So
Thank you.
I would say if today you felt comfortable that your position sizing risk could be 1%, I would say prove it and start at 0.2% of position sizing risk, and then put skin in the game and start growing it and show that with real money, skin in the game, your positive expectancy, and then adjust upwards towards 1%. And if you ever got more than 1%, then we have a second conversation. That's how I would do it. Whatever your number is you think you can handle, I just say start at 1/5 as a rule of thumb. Prove to yourself with skin in the game that you can be positive expectancy over a large number of trades that are statistically significant, and then you're good to go. That's what I would say. Fair enough? All right, let me close this up real quick so they can start processing. So if you're in the sound of my voice, we'll start the nightly strategy podcast in about 10 minutes. Thanks a lot, guys. Send your questions by email, and we'll get to it the next office hours, which is Sunday. Take good care. Yeah, Sean, that's kind of a typical night. So just fire hose is in effect. I can't
Yeah,
help
a lot of
it.
information.
I can't help it. That's just the way it is. But that's why I record them, and it'll be posted later tonight. So
Okay.
there we are. We'll see you
Thanks a
guys
lot,
soon.
man.
Yep.
Yep.
Take good care, guys.